Alibaba was a huge position. You really loaded up in the first quarter. You cut back, I think, in the second quarter. What are you doing now? Did the China moves over the last few days, but just because you were saying in the past you wouldn't go more than 10 or 12%, or the most recent things we've seen are that you have about 12% of Alibaba. Does that mean you put those aside and you would own even more than that?
As I said, the value at risk model is what I sleep at night. I went over that limit on the Fed announcement, in the last week. I went more when they said a day or two ago on their Fed, and last night I did more.
Just Alibaba, or are you talking JD, Baidu, PDD, the two Chinese ETFs, everything China? ETF,
how we do futures, right? Everything.
You just heard billionaire investor David Tepper from Appaloosa Management talking about the China investment. Basically, he's extremely bullish on his investments. He already has quite some companies in his portfolio and some big positions as well. As you've heard him say, he is increasing his exposure quite aggressively. Now, I said buy everything. We've heard him say this in the past. I found a clip from 2010 where he says around the same thing.
Look right now. What do you got right now? I just got a Fed. And what did they tell me? What did they tell me, Joe?
The FOMC?
What did the Fed just tell me?
The spigots are open. They're going to stay open.
And what did they say? They say they want economic growth, right? Is that what they said?
Yeah.
And they said, we want economic growth, and we don't even care. Not only do we not care if there's inflation, but we want a little bit more inflation. Have they ever said that before? Do you remember in your career before this?
No.
Did they say that? No.
So QE2
they said
is
they want the market up. Okay, so what am I? I'm going to say, no, Fed, I disagree with you. I don't want to be long. I don't want to be long equities. We're a bond place, but we changed up to a little bit more equities. Either the economy is going to get better by itself in the next 3 months, and what assets are going to do well? You can guess the assets are going to do well. Stocks are going to do well. Bonds won't do so well. Gold won't do as well. Or the economy is not going to pick up in the next 3 months, and the Fed's going to come in with QE, right? Then what's going to do well? Everything in the near term. Everything.
Now, of course, different times, right? Different times, great financial crisis. Right now, yes, we had a pandemic, we have high inflation, stuff like that, but I don't think we were close to the levels of destruction, desperation as we were back in 2008. But it's interesting to hear him say, or at least indicate the exact same thing 14 years later. Of course, now he's also specifically talking about China and Chinese exposure. Now, if you're not up to date to what has been happening, basically China weighs injecting $142 billion of capital into top banks. Bloomberg News and Reuters are carrying a story early Thursday citing that China is mulling plans to inject capital worth $142 billion into top state-owned banks in a further effort to shore up the economy. Funding for the injection will mainly come from the issuance of new special sovereign bonds. Such a huge injection would be the first since the global financial crisis in 2008, which of course was quite bullish for Chinese stocks. This comes a couple of days after the PBOC came out with also some positive policy, basically stimulating the Chinese economy. Now, what happens after these types of announcements? Well, Chinese stocks go up, and they go up by quite a lot. They already went up by around 10% or so a couple of days ago, and today they're up another 10-13%. JD is up close to 14% today. PDD, Pinduoduo, not PDD the person, is up 13.3%. KWEP, which is basically an ETF. Basically, if you want exposure to a lot of Chinese companies, just buy that ETF. That's up 11%. Alibaba is up 9.6%, and Baidu is up 8.3%. Now let's dive a little bit deeper into Appaloosa Management's portfolio, the positions there, especially the Chinese ones. If you're interested in that, hit all the buttons, like, subscribe, do all of that. We're on our way to reach 60,000 subscribers by the end of this year. We'd really appreciate all your support. All the videos are free, so yeah, why not subscribe? You could always unsubscribe later. And if you want to support me even further, you can check out all the links down in the description or in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, David Tepper, Appaloosa Management. This is from Q2, so the last time the 13F went out. They've got 37 stocks. The portfolio value sits at $6.17 billion. The largest position is Alibaba at 12.3%. Number 2 is Amazon at 10.9%. Then you've got Microsoft, Meta, Alphabet, Oracle, Pinduoduo, AMD, Adobe, FXI, Qualcomm, FedEx, Micron, Baidu, and ET. And of course, there are some other smaller companies under 2%. Now, in the last 2 quarters, he did add quite a lot to his portfolio when it comes to Chinese companies. So in Q1, he added 100 or increased his exposure by 188% in Baidu. 170, close to 171% added to Pinduoduo, 158.6% to Alibaba, and then to Oracle, United Parcel Service or UPS, Caesars Entertainment, and then opened up new positions in JD, in iShares, in the Queb here, Korean Shares CSI China, which is this ETF. Now in Q2, he added a little bit more to Queb, 2K Holdings, JD, and iShares China when it comes to the Chinese exposure, but he did reduce a little bit, 6-7% or so, to these big names that he added back in Q1, which you can basically see here. This is Alibaba ownership history in that portfolio. So previously it was higher back here in Q1 2020 or so. Exposure percent of the portfolio was 13.46%. And then all the way back here in Q4 2022, it was only 0.65%. Since then, it has of course increased by quite a lot, but the share amount has come down from Q1 to Q2. Like I said, he did reduce a little bit. And of course, since the shares did go up, the price of the shares did go up, the exposure to the portfolio did go up a tiny bit as well. So that's Alibaba. If we look at Baidu, that's a more recent position, let's say, but here back in Q1 2021, only 0.14% of the portfolio, then jumped in Q2 2023 all the way to 3.24%, but we're now back down. Although the shares amount is higher today, the percent of the portfolio is a little bit lower. As for Pinduoduo, back in Q2 2023, was less than 1% of the portfolio. Now it's around 4.18%, but of course, way more shares today than back then. But like I said, from Q1 to Q2, he did reduce the amount of shares, but since the stock price has gone up, the percent of the portfolio has gone up as well. Plus, of course, he sold some other positions, so that makes up the difference. Now, if we compare these companies, Pinduoduo, Alibaba, Baidu, from a forward PE standpoint, Alibaba right now, 11.5 times, Pinduoduo, 10 times, Baidu, 9.3 times. If we look at price earnings to growth, Alibaba, 1.19, Baidu, just over 1, and there is no Pinduoduo here. I don't know why they don't give it that, and the same with price to free cash flow, but I know the number, it's under 0.5. So definitely cheap stocks to own. Same with price to free cash flow from Pinduoduo, it's also quite low. Here Alibaba trades at 13.5 times, Baidu 10.7 times. If you look at EV to EBITDA, 8.1 times for Alibaba, 7.3 times for Pinduoduo, and 5.6 times for Baidu. Now, of course, the stock has gone up in a short period of time without us knowing if the business has suddenly accelerated. I mean, we can take a guess and say that in the last 2 weeks, the business did not improve by that much, right? The growth rates for Alibaba are still quite low. Of course, Pinduoduo growing a little bit faster. Well, not a little bit, but much faster. Yes, valuation-wise, it is quite low. Yes, a lot of these companies have quite a lot of cash. And now with the Chinese government basically stimulating the economy and probably going to encourage these companies to buy back even more shares, we could see reacceleration in growth of these companies. But of course, it will take some time. So now in the short term, it's all about looking for the opportunity, or maybe still looking for a disconnect between the reality and the stock price. I still think these are priced as cheap stocks because there's still some risk attached to it. Plus, the market is, of course, still waiting to see the positive effects on each of those businesses, right? It's great to hear the Chinese government wanting to stimulate the economy, etc., etc. But we want to see those positive effects reflect in those financials, in those earnings report in the next coming quarters. Now, if you don't know which Chinese companies you want to choose, of course, there are the popular ones, like the ones we cover, JD, Pinduoduo, Alibaba, stuff like that, Baidu. You can choose the individual ones, or you can buy the basket here, the KWEB, K-W-E-B, basically the ETF. And here the biggest holdings are Alibaba, Tencent, Meituan, JD, Pinduoduo, Trip.com, etc., etc. So you get exposure to all of those companies, basically like the ETFs in the United States that follow the big tech companies, or maybe even the Magnificent Seven. So basically you get the same, but here purely Chinese stocks. And yes, you see those numbers here because those are basically the stocks that are listed in China or maybe even in Hong Kong or both. Now, he also talked a little bit about the United States. He said he's not going to short it, but purely from a valuation standpoint, it's not as attractive. So it's going to be quite interesting to see what he does with these positions here, the Amazons, the Microsoft, the Metas, and the Alphabet, because me personally, Meta, Alphabet, Amazon are still extremely attractive. I mean, maybe not as attractive as at the end of 2022, but I've covered these companies quite a lot on the channel. I will cover these companies more and more. I still think they have a place in each and everyone's portfolio. I personally own Amazon, Meta, and Alphabet, but I can understand from his standpoint, look, he's now betting bigger on China because first, Alibaba is already a big position for him. He's got Pinduoduo and Baidu as well, and it's working out right now. The Chinese government is indicating that, well, they are willing to stimulate the economy. They're probably going to push these companies to buy even more shares of their own companies since they have a lot of cash. So it makes sense. It makes sense to go against the stream of thought of, oh, China is not investable. And I repeat myself again and again, China is investable if you can manage the risk, if you can tolerate the risk. Maybe that's a better way of saying things. If you can tolerate the risk of it being Chinese stocks, the CCP can do whatever and completely destroy your investment, basically. If you can do that, then yes, you can own Chinese stocks and find the alpha. Because Alibaba, since the 70s, $70, not the 1970s, $70 is up now 45%. That's quite a lot of alpha to be found, right? Because it's not investable? No, clearly it is because people have bought it. So yeah, it's all about choice, whether you want that China exposure or not. Me personally, I have no Chinese stocks in my portfolio. That doesn't mean that I hate those stocks. No, not at all. I can find value in those. I can also find value in American stocks or European stocks. There are still some stocks that are undervalued, that are cheap, that still can grow in the future. So that's about it. That's the whole David Tepper story right now, the China investment. Hopefully this was insightful. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, share your thoughts down in the comment section below, and I'll see you all in the next one. Bye-bye.